Okay, so hello everyone. Very good evening to all of you to join this webinar. Finkasturi Nivesh Private Limited welcomes all of you to the 23rd Investors Meet. Today we'll be talking about a very interesting topic on handling market volatility. So this topic is something that is very relevant because of the times and the condition of the market that we are in. Okay. So having said that, um, we will move on to the session. So a quick overview of the session flow. We'll have a quick welcome disclaimers. Then we'll quickly cover the introduction of Finkasturi team members. We will move on to the main topic of navigating India's next decade. And then a few things on Finkasturi and then Q&A. Before we start, disclaimers. So this is a standard disclaimer that has a SEBI registered investment advisory Finkasturi gives to all interactions. So investment in securities market are subject to market risk. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BSL and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Also, there are a few things we just want to inform the participants. So this session has been recorded. Recording may be made public as per regulatory guidelines. Your participation in the session from this point forward is deemed to you are accepting the recording of the session. We request no stock or security specific discussions or queries. We request all of you to keep the video off and audio on mute. If any questions are there, you can post it in the chat window. All the chat questions will be taken up at the end of the chat as part of the Q&A session. Quick introduction to the Finkasturi team. We have Dr. Niyarkar Pradhan, who is a PhD, a CFA. He is the chief investment advisor of the company. He has more than 35 years of experience in the financial markets, with 25 years with the SBI Group and then also with the Generali Group across India and Europe. Myself, I am Ashwin D'Souza. I am the CEO director of the company. I have a postgraduate from NISM. I have 20 plus years of combined experience in IT and financial markets. Along with both of us, we have 3 team members today also in the call. Neville Montero, who is the Vice President Operations, who brings 7 years of experience with him. And then we have Deepan Sahu and Jatin Makwana, who kind of complete the team. I will hand it over to Dr. Nirarkar to continue the further part of the session. Over to you, Dr. Nirarkar.
Hi, Ashwin. Thank you. Namaskar. Very good afternoon. Hello, friends. It's a wonderful moment today. As we get together, today is 1st August 2026. After 14 days, we'll have celebrated Independence Day. But after 80 years of our independence, political freedom in 1947, if we ask ourselves, are we really financially independent? I'll interchange between English and Hindi just to ask you because many people may not understand English. हमारा अर्थनैतिक स्वाधीनता नहीं मिला है, राजनैतिक स्वाधीनता मिला है, and that is why Finkasturi engages webinar like today just to bring to you what are the opportunities towards our financial goal, towards our financial independence. Friends, our company name is Finkasturi. If you do not know what is Kasturi, Kasturi is a deer and it has a musk. It has a nice fragrance coming from inside its body, but it searches for fragrance outside. Similarly, India to me is one of the richest country inhabited by poor people. and we have to make it reach. It is not difficult, but it is challenging. Go to 300 years ago, 17th century, India was rich country contributing 24% of world GDP. 200 years of foreign rule, 1947, we were one of the poorest nation. Thanks to our governments, industry, all people working together, last 5 years, that is precisely after COVID 2020, India has emerged as the fastest growing major economy in the world. सबसे आगे हमारा देश का अर्थनैतिक प्रोग्रेस हो रहा है. But before that, I just want to know where we stand, what is the opportunity for us, and what is that we want to share with you next few minutes, 40, 50 minutes, some opportunity which you can use for your benefit. Let us look at the big picture. How is the world doing in the last 5 years? Friends, the slide you can see, this is from IMF, International Monetary Fund. What it shows, left-hand side, top left-hand side is the world GDP growth. Last year, 3.5%. This year, 3%. Next year, 3.4%. Friends, what does it mean to us? Before COVID, on an average, world GDP was growing 3.5%. For the last 4 years, it is highly volatile. Average growth is 3.2%. So basically, world GDP is growing less than pre-COVID average growth. Look to the right, USA, the richest country in the world. Before COVID, look at 10 years before COVID, that is, growth was 2.4% average. Last year, 2.1%. This year forecast is 2.3. Next year, 2.2. Much below their average growth before COVID. What I want to share with you, with my 40 years of financial sector experience, I had not seen such a challenging period. We had 2007-8 crisis, many financial crises, but within 1 year or 2 years, world economy recovers. But this time, even after 5 years, not only USA, entire developed economy, world economy has not come back to pre-COVID growth rate. Ashwin, can we go to next slide? But I have some good news for you. India, we are lucky, we are blessed. Government at center, government at state level, and industries, people like you and me, everybody learned some lessons from COVID. Everybody is working harder. And look at this. Last 4 years, our economy grew 7% plus. If you want to compare, what was the growth before COVID? 10 years before COVID, you take average, it was around 6.4%. That means our economy is growing about half to 1% higher than what we are growing before COVID. It's a big difference. Unique in the world today, India is growing better than COVID, pre-COVID rates. But this is not all. Look at the other side. Whole world after COVID, their inflation is 1 to 2% higher. Okay, growth is lower, inflation is higher. In other words, if I'm not a student of economics, the citizens in developed countries, they are becoming poorer year after year. Only exception again is India. You know what is our inflation? Last 5 years, inflation is less than 5%. And before COVID, average inflation, if you take 10 years before that, average 6%. So inflation is down by 1% and growth is up by 0.5% to 1%. This is a robust growth, and this happened, my dear friends, despite volatility, geopolitical uncertainty, war in Ukraine, war in Iran, Indo-Pak war, tariff war. Despite all this, we are going better than pre-COVID growth rate. But I want to share with you, India is an island of opportunities in the ocean of turbulence that we see today. And with this, then question for me is, what is there for me? India grows, GDP grows higher or lower, मेरे लिए क्या है इसमें? Correct? And for that, friends, let me invite our Vishwarup Mahapatra. He's a celebrated portfolio manager, managing equity for more than last 10 years, and he has managed equity portfolio across cycles. He's a MBA in finance, he is a CFA charter holder, and we are really fortunate to have Vishwarup among us. Hi Vishwarup, hearty welcome to you. Can you please share your insight? And after this his presentation, friends, I think Ashwin, our CEO, will share couple of questions, and there is surprise, I think, prize. I hope, Ashwin, we have a prize, right?
Yes, sir. So we will have a quiz after Vishwaroop does his presentation, and participants, just a suggestion, focus on what Vishwaroop is going to convey to us. The questions are related to what he will be sharing with us. All the best. Yeah. Over to you, Vishwaroop.
Okay,
Yeah,
thank you, Vishnu.
thank you, Dr. Pradhan, and thank you, Ashwin, for the opportunity. Am I audible clearly?
Yes, Vishwaroop, we can hear you.
Okay, great. So good afternoon, everyone. Dr. Pradhan has actually set the context of like where we are, and I thought I'll take you through over next 20-25 minutes about how actually we can use the opportunity that Indian economy provides and Indian markets provide, and what are the mistakes that we do, investors do in the market, and how to avoid those mistakes. So the name of the topic is navigating India's next decade, and investing through cycles, not headlines. So we can move on, Ashwin. So to begin with a question, when the market falls by 20%, what is your first instinct? So there are four options. You can just deliberate upon it, and think for yourself, or maybe put in the chat box. So options are like sell everything immediately because it's down 20%, and FDs of course give a fixed return. So sell everything immediately. Stop checking my portfolio and wait. Option C, invest more in quality businesses, and option D is I'm confused and I don't know how to behave. So just think about it. I mean, my presentation going ahead will cover these aspects. Okay, now at this juncture, what are the questions which come to our mind, right? So why has India outperformed as a large equity market over long term? Okay, it's been many years since like our growth has been quite robust, and accordingly like the performance also, like if we look at over 10 years, 15 years, 20 years, performance has been double digit returns. Second question is like, even if, I mean, we have such a strong structured fundamental, then why the recent underperformance over last 2 years? Third question is like, what mistakes do investors repeat during this volatility, which probably many of us would have experienced in our investment journey over the years? And the final question is, how can we design portfolios to minimize market risks? So we'll, in subsequent slides, we will go through all these questions and answers. So first of all, just to deliberate on, again on Indian economy. So what are the Indian structural growth drivers? Most of us would know about this. So I'll be brief. So India's growth story is propelled by these five levers. Demographics. Okay, so we have a young and expanding workforce driving massive consumption, and consumption is almost like 60% of our GDP, and that's what is driving our economy. Second, manufacturing. So of late, like the government's focus has shifted to manufacturing because that's where the jobs get created. So if you see over last few years, there has been a lot of incentives like PLI schemes which have been given by government to promote manufacturing. Third, and very important, digital economy. So, because we are a young population, there is rapid tech adoption formalizing the entire economy. I mean, in fact, we all know, I think now in terms of internet penetration, even in smaller areas, villages, rural areas, everywhere, I mean, the internet penetration is quite robust. Fourth, infrastructure. Now, infrastructure is something which a growing country always needs, and there has been substantial government capex and also private capex upgrading the logistics, whether it is roads, rails, networks, everything. And fifth, financialization. So here, like there is a massive shift which is going on from physical assets to financial assets. So when I say physical assets, so basically real estate, gold. So these are the form of physical assets where, as a country, we were very used to and accustomed to for over many years. And now incrementally, if we see, a lot of the population is actually moving to financial assets like equities. So these are the five levers which are actually driving the India's growth story of 7.5%. Yeah, next one, please. So, where are we today? In terms of India's economic growth tailwind. So, the GDP graph has already been shown by Dr. Nirakar. So, if I just take you through the factors which is what are there currently. So, there is an earnings cycle. Okay, so earnings cycle is something which matters for stock market. That is the most important factor. Okay, so the companies which are listed in the stock market, if they keep making profits, then accordingly the output will also be good. So the stock returns also will be good accordingly. So we have seen double-digit earnings growth in over long term, and probably we will continue to see those kind of earnings growth because if our GDP is growing, real GDP is growing at 7.5%, our nominal GDP, will grow at probably 10.5%. So nominal GDP is basically real GDP plus inflation. So if the nominal GDP growth is at 10.5%, so for the good companies, growing their earnings at like 12% plus is not difficult. So as long as earnings growth is there over long term, the stock market it will reflect in the stock market performance as well. Second, liquidity. This is a very important aspect wherein like we have seen of late a lot of FI outflow which has happened because of what is happening globally over geopolitics. Now, what has kind of insulated us is the domestic flows. All the investment which goes to through mutual fund, insurance, and everything that comes to market through the domestic investors or retail investors is actually has balanced out the FI outflows. Third, interest rates are at reasonable level. So we had a little bit of higher interest rates 2 years back, but after the cuts by RBI's Monetary Policy Committee, we are at a very reasonable level, and interest rates are very important factor in an economy because that will drive a lot of things like consumption, capex, and everything. Fourth, inflation and fiscal position in both are under control. Unlike many large economies, we are quite well placed over there. And final thing, which is most talked about of late, is the global risks. Okay, which where there is we hardly have any control because if something happens in US, something happens in West Asia, it impacts us. Last year there was tariff war, uh, and this year it is starting March. There has been crisis in West Asia, and of course, like this is the most important risks which is there currently. Yeah, next one. So this is just a lot of numbers, but I'll just make it simple. So last 2 years of low return. So if you go to the last line, current 2 year range. So if you see the returns is minus 2.6 over last 2 years. This is between June 24 to June 26. We rarely see this kind of no return or negative return over a 2 year period in Indian market, but this time we have seen that, and we have plotted here like how the situation has panned out earlier when we had such kind of 2 year period of low return, right? So starting with Jan 2000, all those periods we have plotted here. If you see post a muted 2-year return, the next 12 months and next 24 months are actually very good returns, followed by very good returns. Okay, so I'm not forecasting any returns from here on, but I'm just showing like how historically it has been, and if the domestic tailwind is there in terms of earnings growth is there, and the West Asia war is under control, we should have a good year going ahead. Next, please. So this is what has actually gone wrong recently. This is to the question that I had asked earlier, that like if India is structurally so resilient, then why the performance is so low over last 2 years? First, to begin with, geopolitics, which is escalating tensions in West Asia, impacting the sentiment. So whenever there is such wars, then there is usually foreign money outflow happening from India, and that impacted us. Second, commodities. There was a sharp and sudden surge in global oil prices because of West Asia war. And whenever, because so we are a large importer of crude oil, of course, and whenever there is a sharp surge in oil prices, it impacts our economy. Our rupee depreciates, consumption goes down, and that impacts the markets. And the third is currency, as I mentioned, currency volatility. So, our INR versus USD was somewhere around 87, 88 last year. Now it is close to 97. So that's a sharp depreciation which has happened. Again, when such sharp depreciation happens in the currency, that's negative for equity market. Third is disruption related to AI. Right. So this is a factor, a new variable which actually came through over last 1 year, wherein there is a perception among investors that India doesn't have a lot of AI stories, while countries like US and South Korea, China, in fact, they have a good AI story in terms of the companies, whether it is software companies, hardware companies, like Samsung, SK Hynix. So that's where the money flew. So since like there was a perception India doesn't have any AI story, money moved out of India and flew to countries like South Korea, right? Some of it is bit reversing of late. As you would have seen, like South Korean market has actually corrected, big time, almost 40% from its high. But yeah, I mean, still long way to go. So that is this AI disruption also impacted Indian market. Then earnings miss, of course, like recently there was weak earnings in certain sectors. While we were used to double-digit, growth rate. Final one, the valuations. We were always trading at a premium to the emerging market peers. So since the starting point of valuation was high, so that when there was profit booking, India got impacted more than other countries. So what have we learned from, so we have plotted here for last almost like 25, 30 years. What is the lesson from market history, right? The point of putting up this graph is, if you can see, there has been corrections, in between. I have mentioned in the right hand table also, like what are the events. So for example, global financial crisis 2008-9, there is a correction of 60%. Then there was, US Fed related rate hike related taper tantrum in 2013. Market fell by 12%. COVID crash, we will all remember, corrected by 38%. In 2022, also global inflation shock, markets corrected by 18%. In spite of all these corrections, if you see, I mean, the Nifty chart or Sensex chart on the left hand side, markets have gone up, substantially over the years, right? And if I put the Nifty Total Return Index, the compounded annual growth rate, in spite of last 2 years being no return or muted return, if you see 5-year return, CAGR return is 10%, 10-year is 12.5, 15-year is 11.4, and 20 years is 12%. Very healthy returns. And equity, mind you, one of the most tax efficient asset class. I mean, when you sell an asset, so the tax rate that you pay is much lower than other asset classes. So these are very healthy returns over long term. Now moving on to since we are talking about the markets, like what are the biggest investment mistakes that we as investors do? First is buying stories instead of businesses. Like we read a lot about theme stories in newspapers and all. I mean, uh, probably this is the new theme where like market will do well, whether it is small cap related, mid cap related, and we buy without understanding the fundamentals of the company. Second is ignoring valuations. Valuation is a very important factor when you buy or sell a stock, because even if it's a very good company, if the starting valuation is very high, for example, like who people who would be already investing in markets, they would know. So, for example, like we have seen many companies in the FMCG sector wherein the companies have not given any return over last many years because the starting valuation was extremely high, and if there is little bit of earnings negative surprise, that actually completely makes the stock underperform for many years. Third is over trading. This is very important for retail investors because a lot of times we think that if we do intraday trading, and we make more money rather than long term investing, right? So the intraday trading and FNO derivatives are very specialized kind of, for that specialized attention is required, and expertise is required to do that. Okay, without expertise, if somebody is doing it is much more riskier than the cash investments. Fourth, following social media tips. Again, I mean, similar to the first point, wherein like we get some stories in social media, and without understanding, we just follow it. Fifth, ignoring asset allocation. So asset allocation is very important. Like what I mean by asset allocation, like for every person, there has to be a proper asset allocation in terms of where you are investing. For example, like person at the age of 50, they would have a very different asset allocation, like equity, let's say at 50%, fixed income at 30%, gold as 20%, right? So I mean that at the age of 50, the kind of asset allocation, and at the age of 25, the kind of asset allocation which will be required are very different, right? At the age of 25, when like you have, let's say, 35 years of your earnings left, you can take higher risks. But at the age of 50 or 60, you can take low risk. So accordingly, your asset allocation between equity, fixed income, gold, real estate should change. Next one is trying to time the market. Again, most of the time we think that we can time the market. We sell now and we buy back when there is a correction, and the correction never happens, right? And the vice versa. Like we we just wait for a correction, and like we buy a stock, and then the stock falls further another 10-20%. So basically, I mean, the investors who actually are there for long term, they should just invest and you know let the market actually play out, and then the CAGR returns would be good. As I mentioned, like 15-year, 20-year, the returns have been quite robust. Lack of patience again. Here, like if at the first market correction, you just move out, sell, and move out. The final one is recency bias. So recency bias is basically if market is doing well, let's say small cap, mid cap stocks are doing well, and you think that it will continue to do well because last 1 year it has done well. For example, gold. Gold had done well for last 1-2 years, and people think that it will continue to do well. It doesn't happen that way because there are always cycles for every asset, and every asset is bound to go up and come down. So we have to be very cognizant of that. Yes, next one. So this is just cycle of behavioral biases, like how an investor actually, behaves, over period. So starts with optimism. Okay, so there is optimism. Okay, I will make money from the equity market. Goes to excitement. Okay, probably he makes some money from the market. He is excited and puts in more money, and then moves to euphoria zone, wherein like markets are overvalued. He has made good money, but still he is greedy. He puts in much more money capital in the market. Okay, And then comes the market down cycle. Okay. So little bit of correction in the market, let's say 5-10% correction. He thinks that okay, it's a minor correction, market will bounce back. He stays put. Then further 5-10% correction. Then the fear comes up that what will happen to my hard-earned money. Then further correction, panic level. There is no rational decision which is left, and then further correction in the market. We move to the despair level, wherein probably one will capitulate and sell their holding and just move out at the wrong time. And then again, once market moves up, then there is hope, and then the recovery phase. So this cycle continues to play over the years, and we have seen many cycles like this. So to summarize, like investors actually often lose money because of behavior rather than poor investments. So as long as we can control our behavior, it is highly likely that we make more money. So there are certain like case studies on behavioral biases I have put in here. First one is herd behavior, like small cap, mid cap rally example I have given of 2023-24. There are strong returns in small mid cap stocks. It attracted a surge of retail participation in the market. Everybody thought that small cap, mid cap rally is here to stay and will just, continue to buy and make money because everyone else was making money. Second, behavioral bias, panic selling, the COVID-19 crash, right? In March 2020, Nifty fell by almost 40% in a matter of few weeks, and everybody was panicking. And a lot of people sold actually at the bottom of the market because they did not know what to do. Uh, Again, hard-earned money, we don't know how it will play out. And those investors who actually bought those lows, they got rewarded handsomely. As we know, like post the COVID lows, the rally was significant in 2021 and 2022. Third one is recency bias. So IT sector performance in 2021 versus 2023. See what happened here is like post COVID, there was a surge in digital service requirement, right? All companies wanted to implement digital capabilities so that if there is anything like COVID shock going ahead, then they will at least have some manageable business operations. So that's why IT stocks delivered exceptional returns during the pandemic and little after pandemic. And many assumed that this growth would continue indefinitely, which did not happen. As we know, right? Last 1 year, in fact, it's been very bad year for IT stocks. Because of various reasons. Fourth one is overconfidence bias. Again, bull market in 2021. There are a lot of first-time investors who experienced quick gains, and this created the confidence that stock selection was very easy, and it encouraged concentrated bets. So, for example, out of let's say 100 rupees investments, people are investing like 50 rupees in one stock and another 50 rupees in two stocks, right? If both the stocks had have they do not do well and they correct, then there will be sharp drawdown in the capital invested, and it will be very difficult to manage afterwards. So diversification is very important. And the final one is availability bias, wherein like the defense railway stocks, there was a rally in 2023-24. There are constant media coverage that time. These sectors were very highly visible because you are seeing it everywhere in media channels, TV and all. Then, the investors often conclude that these are the only attractive opportunities while they're not, right? I mean, there are so many other opportunities which actually you don't get to see in the media. Yeah, next. So, just to summarize, like how wealth creation has happened through staying invested. Investment period, if the investment period is 1 year, it is highly variable. We don't know what will happen in next 1 year. It is difficult to predict with all those variables. Investment period over 3 years, it is moderate. There is a degree of likelihood that investor will make money if he stays put. 5 years, decently positive. Across 5 years, making money, there is a very good probability of making money. And 10 plus years, historically very strong. Like that, those numbers we saw earlier, like 10 years plus, the returns have been very good. So, time in the market is more important than timing the market. So that's the quote that we should always remember. Then the power of compounding. Again, this is just some of the numbers that I've shown here. So if 10 lakh rupees is invested, at various return level, so 10% CAGR, 15% CAGR, 20% CAGR, what will be the value of that 10 lakh after 20 years? And you see the difference, like, there is not much of a difference between 10% and 15% CAGR, right? But you look at the difference in the money that the value of the portfolio will be after 20 years. At 10% CAGR, 67 lakhs, 15% CAGR, 1.64 crore, 20% CAGR, 3.83 crore. There is a significant difference between the value of this portfolio worth. And because so that is the power of compounding. As you hold on to your investments, there is a little bit of change in compounding returns also make the big difference. So 5 to 10% improvement in annual returns compounds into dramatically higher wealth over the decades. Next. And this is also one slide I wanted to highlight, that the sector leadership, every cycle there is change in sector leadership, right? So no sector actually continues to, perform. So let's say you like some infrastructure stock or FMCG stock. Just cannot like keep on holding it for like 10 year, 15 year, 20 year, So that's why sector diversification is necessary. So 2003 to 2007, the infrastructure sector was in favor. 2008 to 12, FMCG. 2013 to 17, private banks. 2020 to 22, IT stocks. 2023 to 26, manufacturing, capital goods, and defense. And after this cycle, favorable cycle for the sector ends, the sector underperforms for a long time. So never assume yesterday's winners will be tomorrow's leaders. So just I wanted to put one slide on like how fund managers think, since how we work, like what kind of investment framework that we follow, and in a very simplistic form, I put here. So start with the macro trends. Okay, how the economic indicators are, where the growth is coming from, how the inflation is there, what kind of fiscal deficit numbers. So you start with the economy, then move to sector selection. Okay, you select the cycles, tailwind, switchal sectors. Like as we discussed, there is tailwind for IT sector. Sometimes there is tailwind for banking sector. Sometimes there is tailwind for defense sector. Sometimes so sector selection is very important. And once you select the sector, then you move on to the company research. Okay. Within the sector, which company is likely to be the biggest beneficiary? Okay. If there is a regulatory tailwind, let's say, which company will get the maximum benefit from that regulatory tailwind? Then we move on to management quality. Let us say we get a very good company in, based on the numbers that they have delivered. But management quality is not good. Then over long term, most likely that company is not going to perform, because at the end of it, people are the who will drive the success of that company. So management quality is of utmost importance. Then valuation. So as I mentioned earlier, valuation is very important. So what is the intrinsic value of that company and what the price you are paying? No point in buying at a very high value, and then regretting later. So valuation is very important. And accordingly, after taking all these factors into consideration, portfolio weight. So accordingly, we design the portfolio with weights to various stocks, okay, and stocks and sectors. And of course, there has to be a diversification, across various stocks. We cannot take a lot of concentrated exposure. Next. So I think this is my final slide, just to summarize what we have already discussed. The 5 timeless principles of investing. I think this is when I was starting out in the markets, like I used to read all these books, and it has helped me over the years extremely. And some of those principles are put here. So earnings create wealth. Okay, if a company is giving profit, earnings growth continuously, eventually that company will perform well. Okay, that will make returns for the investors as long as they are doing well in terms of earnings growth. Second, volatility is the price that you pay to remain invested in equity market. So equity market is not like a fixed deposit, right? There is volatility. So 1 year you will get like minus 10% return. Next year you will get like plus 20 or plus 30% return. So that is part of equity market, and you have to accept it. Third, quality businesses consistently outperform over time. This is one thing like we should never forget, because if some business is where there is management quality is good, where board level quality is good, promoter level is good, that they always do better than others. Fourth, patience beats prediction. So stay disciplined, stay invested. Again, market, staying in market for long term always rewards. Last one, asset allocation matters. This is very crucial than timing the purchases. I have already mentioned like how for different age groups the asset allocation would be different, and it is always good to have some diversification in terms of asset allocation. Some investment in equity, some investment in fixed income, some investment in other assets. So this is a quote by Howard Marks, one of the large hedge fund investors in US. Good investing is not necessarily about making good decisions. It's about consistently not making big mistakes. So that's where I will end. So Ashwin, next, I think we have certain questions, right?
Yeah, so thank you, Vishwaroop. I think that was good for putting your distilled knowledge, I will say. Uh, Picking a stock, there are multiple ways. One way is listen to somebody and just go and buy a stock. Or the other way is what Vishwaroop mentioned. Okay, use all this, what do you say, techniques or experiences, what is shared, right? The different methodologies. That is the other way to pick a stock, and most professional fund managers do that. We appreciate Vishwarup for sharing his knowledge over here. What we'll do is, okay, so again, just a summary, markets never move in a straight line, but when you look at this graph that I show, which Vishwarup also had, that it tends to go along with the economy. If India is going to grow from here for the next 10, 20 years, this graph should, what do you say, maintain the trajectory that it has done for the last 30 odd years. Okay. And last 2 years have been tough. So this is what the market has done in the last 2 years. Okay. It has not gone anywhere. It has gone up a little bit, come down, again gone up. And because of the recent Middle East thing, it has again come down. Okay. And that is the thing where Vishwarup, or at least there was one slide which said after 2 years, if there are 2 years when there are no returns, after that, it should perform well. Okay. So having said that, what we'll do is we'll move to a quick quiz. Okay. So I will ask my teammate to put the quiz link in the chat window. We'll give a couple of minutes to people so that you can go ahead and attempt this quiz. It's a small quiz. There are 5 questions in it. 2 minutes, it should be more than adequate. So go ahead and attempt this. Dipan, if you can post, okay, I think Dipan has put the link in the message.
Yes, sir. Yes, sir.
You should be able to see it in the chat window. Okay.
This is an interesting set of questions. So just please go through and answer, and of course, like, you'll know which one is correct and what's the correct answer, and that also will declare. But yeah, I mean, just answer those questions. And in the meanwhile, Ashwin, like if there are any questions also, maybe we can take some questions.
Yes, Vishnu. Let me just check if there are any questions. Yeah, there is one question. Yeah. So there is one question which I'll take it now itself. This to you, Vishwarup. As you mentioned, every sector performed in different period. So do you suggest taking exit from the performing sector stock in that performing period, or stay invested considering it has a future wealth creator?
So that's a good question. See, you have to continuously keep booking profits, right? So that is there. But the thing is, like, to understand the sector, to know when to enter and when to exit, we need some sort of knowledge and experience to do that. And the experienced fund managers in the market, like who have 10, 15 years, 20 years, they have seen the cycle. They continue to do it. They continue to thrive to do achieve this. So I would say if you have not seen the cycles, you are not experienced, then it is better to actually invest in somewhere where the fund managers can take care of these sector rotations, because they are in the market, they know what's happening in the to the companies. So they will try to time it better than a retail investor.
Okay. There is one other question. The recent Okay. Recently we had this AI boom, right? And we are also seeing in the last few weeks, many of the AI performing markets have been correcting. Okay. So how is it similar to the dot-com boom that we saw maybe in 2000, year 2000, right? When the markets went up hugely in 98, 99, 2000, and then there was a continuous correction or at least a stagnation for 2 3 years post 2000, right? So are we kind of similar with this AI boom, and how does that work in India, like from the Indian market perspective?
Sure. So I would say there are a lot of similarities in a way that that time also in 99 2000 we had seen, a lot of companies where they had gone up like 100%, 200%, 500%, as long as there is, .com in their name, right? Investors were like, without understanding the fundamentals, they were buying because, that was a euphoria era of, technology. Here now, at this juncture, like we have seen, some euphoria related to the AI stocks, and many stocks have actually gone up by 2x, 3x, 4x, right? Uh, I would say, but the in terms of the risks and in terms of the euphoria currently is lot lesser compared to what it was in 99 2000. Why? Because like the kind of companies who are actually making investment is actually companies like, let's say, Amazon, Nvidia, Alphabet. They are very strong cash flow generating companies. The capex that they are making. So barring probably a few companies where, like, there is not enough cash flow to actually sustain the debt or investment, but most of these companies, the magnificent seven companies that we say, they are investing backed by very good cash flows. So even if something goes wrong also, it is less likely that stock probably will correct by 70-80%, which we had seen during the dot-com era, when the correction had happened to the tune of 90-95% also, because there was no underlying business in there.
Okay, got it. So, the next question is, how do we invest when the market is at peak or overvalued? And this is especially when it is a beginner, okay? How do they start an investment and maybe this is more relevant in 2024? That's the question, okay?
Sure. So first of all, like for a beginner, like if he wants to invest directly in stock market, so there are certain rules or principles that they have to follow. And some of the principles I have already mentioned in my presentation, that don't go with what media is, don't blindly follow what media is saying or what your social media posts are showing. That if you buy this stock, then you make 50%, 70% in a few months. So at least, stick to your core areas where there you have an understanding. For example, like you understand the auto sector well, stick to that, or you understand banking sector well, stick to that, and in that sector also diversify properly. Okay. You will never be sure, like whether if you invest in only one company and that company will make money, that is never guaranteed. But if you invest in 10 companies, probably 7 or 8 out of those 10 companies will make money, right? So diversification is very important, especially for beginners, big investor who are starting with the market. And also, as I mentioned, go gradual. Like if you have like 100 rupees investment, start with like, let's say 20, 25 rupees, 30 rupees, especially when markets have rallied sharply, which was the case in 2024. Now, of course, market has cooled off over last 2 years, but so these are the things that one has to keep in mind if you are entering the market.
Okay. Thank you, Vishwarup. Somebody had raised a hand. I think Sudhir Parida. I saw you raise the hand. In case if you have a question, you can go ahead and unmute yourself and maybe ask the question live. That will be really good. Okay, let me see if there are any other questions on the chat. Any of the other participants, you can also go ahead and ask those questions. Okay, one other question is, okay, so this is related to AI tools, Vishwarup. Okay, so I think the question is AI tools like Chat GPT, Google Gemini, Claude, or even YouTube video, right? Is that sufficient to start investing? Because many YouTubers give ideas about what stock to buy or not. So is it something that is relevant to all people, and should people start investing on that basis? Okay, either AI tools or the YouTube videos that are out there. Okay, your take on this.
Sure. So there is no generic answer to this because there are some very good tools available, and there are some good investors and people who are actually you know posting their videos in YouTube. The problem is like you like if you are starting out, you never know like what is the person who is posting YouTube videos, like what's his track record and how he has performed. So these are things to be checked before actually believing in the in the advice that he or she is giving. And again, on AI tool, now in the age of AI, everybody is using AI tools, right? So AI tool will not per se give you investment advice, but if you can design the AI tool which will fit your requirement, right? So for example, like I'm just typing certain questions or certain guardrails, like show me those companies which have made more than 15% sales growth over last 10 years. Okay, so those type of guardrails which we can make using the AI tools, and we can use it. But yeah, I mean, as I mentioned, there is no generic answer to this. It varies case to case basis.
Okay. One thing I'll also add, Bishwarup, in his presentation, right, over 10 to 15 slides, he gave us a framework. So that is one way you can understand this framework, learn this framework, and it does take a lot of experience and time, but it gives you a higher accuracy on how stocks are picked versus the other way, which the question was, can we look at AI tools, which might be a faster approach, but if you do not understand the faster approach, there could be chances that you might be making bigger mistakes. Okay. Okay, with that, I'll take one more question from Rohit on the chat, and others are also requested. If there are further questions, please do put it on the chat or raise your hand. You can ask it live also. Okay, but I'll take this question first from Rohit. His question is to Vishwarup. In your opinion, is getting asset allocation right alone sufficient for long-term investment success? Or are there other factors that are equally important? Okay.
Yeah, sure. Rohit, so asset allocation is the starting point, I would say. Okay. So if your age is, let's say, 30 or 40 or 50, based on your age and based on your risk taking capabilities, your willingness to take risk, so there is an asset allocation which is prescribed. Okay, so as Ashwin and Dr. Nirakar mentioned, so there are multiple investment advisors who actually can advise you based on your risk profile. that what type of asset allocation suits you. Okay, so that is the starting point. Once the asset allocation is finalized, then you move to investing in those, under those asset allocation principles, you have to invest, right? So let us say 60% you have to invest in equity. Then within that 60%, then you have to select whether you are investing directly in stocks, like through an investment advisor, through mutual fund, and whether you are investing in it prudently, you are doing the concentration, you are taking care of the concentration risks, you are diversifying your portfolio. So all those questions come after, the asset allocation is finalized. So asset allocation is just the first step. Then post asset allocation, you have to do all those other activities like stock selection, mutual fund selection, investing in fixed income securities, which securities to invest in. So those things will come later.
Okay, thank you, Vishwarup. So we'll just pause the Q&A for a couple of minutes participating in the quiz.
Great. Thank you, Ashwin.
Yeah. So Neville, do you want to do the final vote of thanks?
Yeah, I will continue. So, ladies and gentlemen, as we draw this webinar to close, I would like to brief a moment to express my sincere gratitude on behalf of everyone here. First and foremost, a massive thank you to our guest speaker, Mr. Vishwarup Mahapatra. Thank you for sharing your time, expertise, and invaluable insight with us today. Your presentation was highly engaging and gave us all some incredible practical takeaways to reflect on. I also want to extend my appreciation to the organizing team. A lot behind the scene efforts goes into ensuring a seamless virtual event like this, from coordinating the schedules to managing the platform and technical details. Thank you for making today's session possible and running it so smoothly. Finally, to our participant, thank you for joining us from wherever you are tuning in. Your active engagement and thoughtful questions are what truly brings this session to life. We know how demanding your schedules can be, and we deeply appreciate you choosing to spend this time with us. We hope you found today's discussion valuable. Should you have any further inquiries or require additional details, please free to reach us or from the contact information provided on the slide. Thank you once again, everyone. Have a wonderful rest of your day, and we look forward to see you at next event. Thank you.
Yeah. Thank you, everyone.
Thank you all. Have a wonderful evening.
Thank you.